soft landing scenario where you have jobs are still good, but the excess savings is coming down now. It's only $500 billion, down from $1.5 trillion. So more and more people, as they spend down their savings, are going back to work, which is very important. The labor force participation rate, which came out last Friday, was at 62.5%. That's been steadily moving up over the months. And what that means is more supply of labor is coming into the market, which means wages will stop going up. They don't have to go up so much to attract labor. And that's going to offset the increase in inflation while at the same time putting more people back to work. And that does create the perfect scenario of a soft landing, provided the Fed does, in fact, stop at these levels, as we were referencing.
The soft landing scenario is even clearer after this. And as you see the moving numbers, the dynamics going into the right direction, when are we going to see the inflation rate in the U.S. will ultimately reach the 2% target?
Not for a long time. So the idea of setting a target of 2%, which is unachievable in the short term, is the objective is to pin long-term inflation expectations. That's very important for consumer behavior because you don't want a wage price spiral where people believe prices are going to go up and up and up and they start buying and buying and buying. So they continue to put that target out there over time, they emphasize, which could take 3 to 5 years. And that helps people be grounded in the short term and not act irrationally in the short term. What we saw the last time we had debt to GDP of 120% was post-World War II. They let inflation run above trend about 3 to 5% for 3 to 5 years over that period. And it slowly came down and we inflated away some of our debt exposure.
So we're going to really see that coming, hopefully. And moving on to another issue about the debt default, Thomas, how do you actually see the potential for strengthening in the U.S. capital market amid so many threat of debt default and also shocks in the banking sector? Because as previously before, we already know that Minister of Finance Janet Yellen already said that the United States will have some sort of risk of default in the 1st June of 2023.
Yeah, the U.S. will not default. The U.S. will never default. They will raise the debt limit once again. They've raised the debt limit 102 times since World War II. This is just one more feather in the cap of climbing the wall of worry. The market wants to push higher. First, the market was afraid of the jobs report. Well, the jobs report came in better than expected. Then they were afraid of the Fed meeting, and Jay Powell came out and basically said we may be at the level and effectively paused. Then we were worried about inflation. Inflation came in better than expected. Now we have to worry about the debt ceiling for the next 2 weeks until they finally raise the limit and kick the can down the road. So all of those things are happening. But the most important thing, Safrina, in the background is earnings are coming in much better than expected. They came in at negative 2% so far, with 85% reported, as opposed to expectations on March 31st were negative 6.7%. So for the first time in many months, earnings estimates for next year have actually started to turn back up again. And the market is going to start to look at that in coming weeks and months and start to discount the earnings recovery for 2024. Right,
Thomas. And as we know, on Tuesday, Joe Biden and the House and Senate leaders of both parties, Republican and Democrats, also met to discuss the impending economic crisis of their own making. So what do you think is the final decision? Is the debt ceiling is going to raise, or what's going to happen?
It's going to be the same decision as the last 102 times they raised the debt limit since World War II. They're going to raise it once again, and they're going to squabble down to the last minute, and you'll see some volatility. Hopefully, they'll be a little bit more productive this time and maybe not take it down to the wire and actually be constructive and do their jobs, but we won't hold our breath. Ultimately, we know the outcome. The question is how much volatility between now and then.
And if you said there are no worries, what are actually the sentiments that is being caused to the market because of this crisis of, yes, we're going to hide the debt ceiling or not, or is this just a drama between both political parties?
It's just a drama. It's a normal process. The Republicans want to reduce the spending. The Democrats want to continue the spending. This has been going on for 250 some odd years. This will never change, and they'll continue to raise the debt limit over and over. I mean, you may get some spending cuts at the margins. There may be some negotiation at the margins. There may be some volatility in the short term, but ultimately it gets raised. And that will be one more box that we check in the wall of worry so the market can push higher.
And about the level of debt to GDP ratio in the United States, which is around 139% to the GDP, is it still a healthy level, Thomas?
It's not, but the solution for that is the same thing that we did after World War II. When debt to GDP was 120%, we borrowed to fight a visible enemy back then. This time we borrowed to fight an invisible enemy in COVID. And what they'll do is they'll run inflation above trend. They'll continue to say we want to get to 2%, but in reality, they have to keep inflation at 3 to 5% in order to bring down the debt. And what happened from 1948 to 1953, the last time we had this problem, they ran inflation above trend, and actually the debt to GDP ratio, they grew their way out of it, and it dropped from 120% down to 63% in just over a handful of years. And I think if they follow that playbook once again, I do think we can grow our way out of this, and in a handful of years have debt to GDP at more normalized levels.
Right, we are hoping so. And lastly, Thomas, how do you think all these economic dynamics will impact the emerging markets like Indonesia?
Well, I think it's a very, very promising time for emerging markets, because as the Fed has finished their tightening cycle, the dollar will weaken, and these are historically those times when emerging markets dramatically outperform. If you look at the last 10 years, the S&P 500 has returned about 12.09% annualized, whereas the emerging markets has only returned 1.8%. That was following a 480% rally in emerging markets from 2001 to 2007. So I think now with the dollar weakening, with the Fed ending the tightening cycle, with the demographics, with everything else happening, I do think we're going to see a period for the next 3 to 5 years of dramatic outperformance in the emerging markets. And as you know, China and Taiwan make up about 45% of the index. And they're, after 3 years of anemic growth, they're going to grow earnings at 18.5% this year, 14.5% next year. And they're trading at just over 10 times earnings versus the S&P, which is trading at 18 times. So I think the relative value is there in emerging markets, certainly in Indonesia as well. And I think the future is very, very bright for emerging market investors.
We're hoping so for the emerging markets. We're having a good future. And lastly, probably, Thomas, it is actually still unclear whether the era of high interest rate and all these dynamics, whether the debt ceiling, the dollarization and so on, has an impact on the psychology of investor, especially in high-risk investment instruments such as the equity and capital market. Do you think it is still a perspective to invest in equities?
I think this is a great time to invest in equities. You've basically had, in the S&P 500, you've had no progress. Not only is the price the same as 12 months ago, it's the same as 24 months ago. So we've been digesting the post-pandemic gains for over 2 years now. The earnings estimates are starting to go up. I think the only thing that's changed is 2 years ago, you could make money investing in growth companies that had no earnings and no cash flow because money was free. Moving forward, you're going to have to be in businesses that are earning money, generating cash, and growing earnings. And if you stick to those solid companies that are growing and generating income, you're going to do extremely well in the next phase of the bull market.